Well, we'll just get started. We just talking. We're not overly formal, so we just talking, brothers. Blake, that was you who asked that question about getting started.
Yeah. Yeah, I see I've been seeing you talk about it for probably years now, but
Mhm.
just more recently seeing the kind of consistency of those posts. And somebody made mention of it going over people's heads, and I was like, yeah, it's mine because I really don't know what y'all talking about. So I was like, but I know that's something that was beneficial, and I need to
Mhm.
really start to look into, but I don't know where to start. So,
So do you have
um,
a do you have any? Are you doing anything yet? Do you have any type
what do
of
you mean?
brokerage account?
You say any type of what?
Any type of? Are you trading? Or do you have any kind of account where you trading stocks or doing anything?
No.
Okay. Oh, Steve, what about you?
Yeah, I have a couple. So, of course, the 401k, a couple IRAs, and HSA account, health spending account. I do some trading, some option trading out of that account,
Mhm.
and I just realized that you could actually use some of your investment accounts to do that through. But they're all through Fidelity.
Yeah.
And I was big into crypto a couple years ago. I should have stayed in. My wife made me get out, and it kind of took a turn. So,
Mhm.
I'm still a little salty about that, but it's all good.
It's all good. So just to set the stage, I'm an investor, not a trader. There's a there's
Mhm.
there's a difference. So the traders usually do more in and out and more short term gains things. There's nothing wrong. Neither one of them is better than the other. They're just different. It's based on what it is your goal is and what you're trying to accomplish. So Blake, for you, what I would say is, first of all, if you are interested in participating, that you can send me. I think you got my email or something, and I'll send you a couple of brokerage account activities or options for you to look at using that are all
Mhm.
free. I don't work for anybody. I don't get paid off of these guys. So which one you choose or how you choose to go, it doesn't matter to me. I use a couple of platforms. I don't just use one. I use a couple because it helps me balance and understand and make sure that what I'm seeing is across multiple sectors and somebody's not just playing with the information. But I'll send you a couple. I'll also send
Thank
you,
you.
Blake. I'll also send you. So I use a separate platform that's not free but it's cheap called Acorns. And the reason that I'm mentioning Acorns to you is because I just saw you with your kids, right? Acorns is a platform that has a thing called Acorns Futures, or it's designed around kids. And so
Mhm.
all of my kids have they have, it's my account and then they're set up under there. They don't have access to it or can't touch it until they turn the age, whatever age I say. But for them it's 21. The
Mhm.
difference in doing it in Acorns and doing it in a Fidelity or doing it, those brokerage accounts, you must be 18 or over in order to get one. So if you say, okay, I'm just gonna save for my child, or I'm gonna do it this way, you'll pay taxes on that. Under the
Mhm.
Acorns platform, it's their account and they're below age, so there's no taxes. It's tax exempt. So that's the
Right.
difference. So the fee is like $3, depending on which one you get. It's like $3 a month. It's nothing, and that one, you actually aren't picking stocks. You just pick, you say, I want to be aggressive, I want to be modest, or I want to be real conservative. And then it's going to
Mhm.
pick that platform, those stocks for you. And then you can actually see them and then watch how they move and determine if that's something you want to do on one of the individual stock platforms, which is something
Right.
that I do. Now, so to your question, how do you get started? There's there's a lot of different information that's available to, getting started. But what I would say to you is the stock market history and the things that I share with you guys, stock market's been around for over 100 years. There are trends in history that you can just watch and see. The stock market really doesn't deviate. And if you look at the trend over the last 100 years, it's always the stock market is not lower today than it was 100 years ago. So if you'd have put money in 100 years ago, it would be worth more now than it was then. So if you put money in now, guess what? 100 years from now, it'll be worth more then than it is now. That's just the reality. As a community, we were really trained and taught to save in a bank account. Well, banks are designed for transactions. They're not designed for savings. That's just not what they were designed to do. But it was marketed to the uninformed population in that way. Why? Because they make money when you put your money in there. If you put money in a bank today, what that bank does is it takes whatever money you put and it'll put it in one of these conservative systems that we're talking about. If they put your $100 in a system that generates 5% off of that $100, they keep that 5% and they pay you 0.00000001. They spent no expenses and got to keep the money off of your money, where you could have done the same thing. So what I would encourage you to do is to pick one of the brokerage accounts that when you email me, I'm going to send them to you. Just pick whichever one you want to play, catches your attention, your opinion. And then the people who, I'm in a lot of different groups, brothers. So I do a lot of chatting and a lot of talking on these things. But the thing that I share with everybody to start, we got a couple more people on the call now. So I'm going to say this. There's a couple of philosophies that I would encourage you guys to make your own, right? One is it's your money, so there's no wrong answer. There's no wrong answer in Steve's wife saying don't do crypto, and there's no wrong answer in her saying do crypto. It's y'all's money, so there's no wrong there. It's just a decision that you made at that time. All right. So any decision you make, if we got brothers on the call, a brother could decide, you know what, life is short. I want to make a lot of money and spend a lot of money, and I don't need to save anything. That's his choice. I wouldn't do that. That's not my choice, but there's nothing wrong with that being his choice. That's the first. The second one is a quote. I follow a quote from one of our brothers, our former brothers, is Arthur Ashe, is start where you are, use what you have, and do what you can. All right, so put those two things together, and that's going to guide our discussion that we're having today. All right, so again, to start, there are five financial principles that every wealthy person or financially stable person follows. These aren't Fred's principles. These are general principles. You can look them up. You can find them. One is to, you probably heard before, to create a budget. All right. Outline for yourself a budget that works for you. Don't make a budget that is unreasonable and that you won't stick to because you're just wasting time. All right. The second is that budget should, your revenues should not exceed your monthly expenses, right? It's just basic logic that you don't spend more money every month than you're bringing in every month or every week or bi-weekly, whatever your pay process is. You spend less than you make. All right. The third of the five is to build a savings plan, right? To save in such a way that you meet your financial goals. I'm a sidetrack a little bit to say are you, each of you on the call, do you view yourself as more or less important than, let's say, your cell phone? Are you more important to yourself than your cell phone? That's either yes or no, and you don't have to answer it for me. But as I said, there's no wrong answer. You can view your cell phone as your most important commodity if that's what you do or that's what you don't. But what I would encourage you to do in starting in building your savings or your investing plan is to say, hey, I'm willing to pay X for my cell phone. I'll pay myself that amount every month. You pay your cell phone bill once a month. Let's say it's $150. Take $150 and create a savings portfolio for yourself from that $150. If the answer is no, then just keep doing what you're doing. There's nothing wrong with that. But if you value yourself more than that one asset, pay yourself as consistently, as religiously, and as non-negotiably as you do your cell phone bill. If you take and pay that $150 to yourself every month, then for your question, Blake, you create this savings platform, right? And not in a savings account, because I just told you that a savings account, they're using your money to invest it. You want to invest it yourself. So you take this $150 and you put it in. I think Steve mentioned Fidelity. I think it's the one that he said. Let's just say Fidelity is the one you use. Well, most people who when they are using Fidelity, they say, oh, I'm gonna save $150 a month. All right, so I get paid on the first. You stick that $150 in there and you say, yeah, I'm doing good. I'm saving $150 a month. Yes, that is better than what most are doing, but with the financial system that we are talking about, as I said earlier, there's 100 years of data, right? There's 100 years of data. What does this data show? That instead of taking the $150 and putting it in on the first of the month, what a savvy investor does is you take the $150 and you divide it by 20. Why do you divide it by 20? Anybody have a guess? It's 20 trading days in a month, right? So you divide it and say on each trading day of the month, let's say you take the $150 and divide it by 20, you come up with that number. Every day, whatever you're investing in, you buy that amount of that share. Instead of putting $150 all of it on the first, you're going to pay $150 on it over the 120 days. Why do we do that? Well, you do that because there's a mathematical equation called dollar cost averaging. Dollar cost averaging does what? Takes the volatility that everybody talks about in the stock market, it takes it out. It no longer exists. You're always buying on the average. Sometimes you're going to buy high. Sometimes you're going to buy low. Sometimes you're going to buy in the middle. But overall, with dollar cost averaging, which is a mathematical equation, you're going to buy on the average. On the average, the stock market does what every year? It goes up 5 to 7% per year. So you lock yourself into outpacing what any bank, what any savings account, what any CD, what any mutual fund, what any IRA is going to give you. You're going to, on average, outpace it. That's why you do dollar cost averaging. If you buy on a single day, what happens? So the stock market goes up and down. If you buy on a single day, it's going to go, maybe it goes up a little bit tomorrow, but maybe 4 days, 5 days after that, it drops down and you lose money. Or you don't lose money, but you're down on money. So what I encourage you to do is take the $150 or whatever your cell phone bill is, pick a market or a stock or something that you use. My wife drinks Coca-Cola. She drinks Coca-Cola. So one of the stocks that we buy is what? Coca-Cola. because we are consumer of that product. So if I'm going to pay anybody for a soda, give me a penny back. Give me 2 pennies back. I get back my investment over time. I travel significant amount of travel. I stay exclusively at Marriott. So guess what one of our stock positions is? Marriott. So when I'm staying at a Marriott, I'm paying to something that I'm a partial shareholder in. I might not be a billionaire or whatever, but by percentage, I get the same percentage as a billionaire. He just put more money into me than he gets more out. Right? That's how I approach the stock market. Now, one of the things that I've learned later is with these what do they call them? These funds where you buy them. They hold multiple stocks, right, at one time. So you can buy instead of buying Google, you buy an ETF that is technology that includes Google, right? And instead of buying Exxon, you buy an ETF that is oil and gas. And it's going to include Exxon and BP and all of them. So you again, you go and you're moving to the average instead of having to deal with onesies, twosies. The market, in a general sense, was designed to. It scares us off. We get scared and we say, "Oh man, we lost money. Oh man, I made money," or there's a lot of risk. 100 years worth of data shows that there really isn't any risk. The risk is in not to pick on Steve, but Steve was talking about crypto. Crypto's a new technology. It's something that doesn't have 100 years of data. So there is risk associated. There's a reward associated with it if it does very well, but there's risk associated with it as well. But if you buy in what the term that you'll constantly hear is value stocks. Value stocks are stocks that have been around. Who thinks Coca-Cola is going to go out of business and you're going to lose your money next month? Is it reasonable to believe that Coca-Cola will probably still be in business 20 years from now? It's reasonable to believe that they will. That's a value stock. If you buy stocks that are valuable, that have a proven history that you can rely on, then more than likely there is limited risk. Will it go up and down? Yes, it will. But all of the stocks, and I don't want to say all, majority of the stocks that were down during the COVID, when they shut down everything, where are they today? They're at what they were at before COVID or higher, because the stock market trend has grown back to where it was pre-COVID, because that's what history shows us is going to happen anyway. All right. So I was going through the 5 things. I talked about the budget. I talked about living within your means. I talked about setting an investment plan. There's one that's escaped me right now, but the 5th one is your ability to be charitable and give. Right. That's at the end, paying off your debts. That's the one that I left off. Which is, there's different ways to get to that. If you're one of the guys that I followed and read a lot of his stuff and did was Gordon Ramsay. If you're a politician into politics, he was a big Trump supporter guy. So I kind of lost some of my polish for him, but that doesn't change his financial knowledge. Right, it doesn't change his ability to outline a plan that works financially. All right, have you got anybody here heard of the snowball, the money snowball, paying off your bills? That's a Ramsey thing. He created that concept. So just if you haven't heard of it, what the snowball is you take and you line all your bills up from highest to lowest, not related to interest rates or anything like that. Whatever the lowest bill is to the highest bill, you line them up and you pay the minimum on everything except for the first one. All of the extra money you put on that first one till it's gone. Then when it's gone, you roll that money to the second one, and you repeat that. And if you follow that principle, normally with his research, within 18 months, most people pay off all of their debt except for a home. It works. It really works if you do that. Personally, I modified my snowball because I felt like, hey, if I don't feel like something's working, if I can't, if it takes me 18 months and in that 18 months, I never have an extra dollar to do anything that I didn't do 17 months ago, I don't feel it. So for me, I would take a percentage of whatever I paid off. If it was $100, I would roll $90, right? I would roll $90, and the $10, I put it in my discretionary fund to do something else, right? So every time I pay one thing off, I have a little bit more money, and I can feel it. I saw, I think Casey said he's snowballing now.
Yeah, I'm snowballing a few things to pay off. I've been doing it for maybe like 4 or 5 months.
Yeah,
it really does work.
It works. It works. You don't need anybody to do anything for you. It's just you aligning your bills and making yourself the financial priority. And so if you're not familiar with it, if you feel like, oh, I'm drowning in bills and debts, there's a simple, proven approach to attacking that and getting it under control. So if you do those are, again, the 5 basic things that most wealthy people do, or people financially stable do. But again, to the point that I said we're going to spend most of our time focused on, to get started on the stock market or on your financial journey.
We got a question.
Who is that?
ET has his hand raised.
Okay, I don't know how. I'm not financially savvy, brothers. Earl, you have a question?
No, yeah, it's not a question. I just want to make a point of clarification for you. You mentioned the name Gordon Ramsay. It's actually Dave Ramsey.
Dave Ramsey. Gordon Ramsay is chef. I'm sorry, brothers. There's a lot of Ramsey out there. Dave Ramsey.
I knew what you meant. I knew what you meant, but I let you make it, man. But Earl not gonna let you make it.
Yeah, he ain't. That's all right. I appreciate that. Dave Ramsey is
accountability, brother. Accountability.
Dave Ramsey is the financial guy. Gordon Ramsay is the chef. So if you're looking for a good recipe, go to Gordon. But Dave is the financial guy. Thanks, Earl.
Yeah, the wife and I actually follow some of his principles. Now, he's super aggressive in his approach. He's like, you don't need to eat. You can drink water and eat chips for 2 months. He's super aggressive, which is good, if you're trying to get out of debt. But his stuff does work for sure.
Well, yeah, he is aggressive. And I said, for me personally, I took his snowball and modified it to make it work for me. No principle that you're going to find from anybody is a cookie cutter design that will exactly work for you. It's unreasonable for me as a person to think that I'm going to follow a principle for almost 2 years and see no difference in my house and feel like, and let my wife and family believe that is working. It's unreasonable. So by modifying that snowball for my family and doing 90% and keeping 10%, that worked for us because they could see that I use $100. Obviously, if you got a bill, a significant bill, it's more than $100 sometimes. If you got a car note, that's $600 or $700, or some of you Range Rover drivers, that's way more than that. So, but when you pay that off, 90% rolls to the next bill, 10% stays with us, and after it's a snowball. So when you see a snowball rolling down a hill, what happens? Every time it rolls, it picks up more momentum. It's more money. So after you do that for the first, York said he's at 4 months. When he gets to 8 or 9, when he gets to month 8 or 9, it's going to be a big snowball amount of money. Bills are going to start disappearing faster. That's why it cuts off quick at 17, 18 months. The first 4 or 5 months are slow because you put the smaller bills at the front. It knocks them off. But every time it rolls, it gets bigger and bigger. When you get to the end, the only bill by his process that you should have left, the only bill is the mortgage, and they leave that out there by design. Uh, Mortgages is a whole nother conversation for me.
Yeah, just one more thing, Fred. At least on my end, the one thing you said was creating that budget.
Mm-hmm.
Man, you gotta be able to see yourself. You gotta be able to see where your money is going, right? Most people have no idea where their money is going. So it's hard to make a financial plan when you don't even know what's happening with your money yourself, and it's your money. So you have to make sure that if you're gonna do it the right way, you gotta start with a budget. You gotta lay all your cards out there. If you buying Starbucks every damn day, you gotta put that on there.
It's gotta be on the budget.
I'm spending $150 a month on Starbucks coffee. Hey, I'm going to the strip club every Saturday and I'm spending $250. You gotta put that shit on the budget, so that you understand what's happening with your money. From there, you can then just start figuring out what do you need to do to get to where you really want to be. But only you, as the individual who has that money, can really determine that. It's not about how much your paycheck is. It's about what are you doing with the money you are receiving.
Right. Yeah, that's very, very valid points made by Brother Terry. Is the budget? It's your budget. Again, you create it, and you really need the information to know. Again, there's no wrong answer. If the strip club, as he said, is something that you want to do every week, and you can make it work within your budget, and you're staying below what you're earning every pay period, that's your choice. That's why I say it's your money, so there's no wrong answer. But when you look at that, you may say, wow, I really wanted to do this. Here's a way, instead of going every week and spending $300 at the strip club, maybe I spend $275, and that I can use that other $25 to do something else and accomplish other goals. But if you don't know, a lot of times we spend money and we don't know where that money is going or what we spent it on. When you look back and you try to remember 90 days ago, it's really impossible. But what I'll say to one thing I wanted to make sure and say to you brothers who have young kids, I don't. My youngest is now 16, so I don't have young kids anymore. There's absolutely no reason that your child, if they're 10 or below, shouldn't be a millionaire. There's no metric. There's no metric, and it's not something that is unattainable or difficult to do. Again, money moves on a snowball. Any money you invest or put aside moves on a snowball principle anyway. If you have right now a savings account for your child and it's in a bank, any bank that you name, you got the wrong answer. That same money moved into a proper fund that the wealthy use, even something modest that's no risk like a CD earns more than your savings account. Your savings account is, again, 0.0005 cent. You can get a savings account that is 4%. So you're gonna earn on that same account almost 1,000 times more on the money, and you're doing nothing different. All right, just little bitty things. Each element of of your financial journey has other elements that below it. You could be doing real well. I'm doing real well, but there are things that I still learn and come in contact with all the time that help me relook things and adjust things and get better. And as you get better, you make more money. But the most important thing to know, again, is if you have a young child, your child can be a millionaire, and it ain't gonna cost you a whole lot of money every day. If you can spend $150 a month kicking it and doing some of the stuff that I see brothers doing, you can spend $150 on your child a month. And if that child is very young, 3, 4, 5, that $150 in 25 years, dude, they will be on a path to be a millionaire. They'll be on a path to be a millionaire. I'm gonna slow down and see if we got questions or topics other brothers want to talk. But Blake, send me an email and I'm gonna send you those 3 portfolios just for you to consider. But remember, look them up, look online, find any one that you're comfortable with, and start your journey. Start with a free one for you. Don't. Some of the other brokerage firms, some of the larger brokerage firms traditionally charge you by transactions. The one I'm going to send you is free, so there's no transaction fee. And most of the smaller ones now they'll give you a free stock, or they're going to give you something so that you can watch and learn, and it's free. So send me an email and I'll send you that.
Okay, gotcha.
All right. Questions? Ideas?
No questions. I'll just the point of personal experience. I feel like I've done well in my career, but since I've been married, my wife has been preaching. We're good making money, but we also need to learn how to also save money, right? Because you make a lot of money, you can spend a lot of money. The goal is to keep it, right? So, we both are very successful, but we've been shifting our mindset to how much can we save and how much can we make passively, right? So you mentioned some savings accounts and things like that. Well, we've shifted a lot of our money, cash, to money market accounts, right? Which have recently been upwards of 5%.
Right.
Which is good. We've also shifted some money to like bonds over the long haul. They've been 6% and they fluctuate, of course. But the goal is always to more passive income and more saving.
Sure.
And so that's where our mind is now. So if you have any thoughts or points,
sure. So those tools there's nothing wrong with those tools. Bonds, government bonds is the assumption that I'm making, that you're talking about. Government bonds, money market is good. I would encourage you to pay attention to your money market account. Money market accounts are variable interest normally, which means that it may be 5% today, and then you wake up tomorrow and it's 0.79 because the bank did something. And if you're not paying attention to it, you're not going to get the value that you want. So I have a money market account. There's nothing wrong with money market accounts. But money market accounts, by design, most banks make them variable, so they have the ability to offer you a product that is very attractive. And then what most people don't do is watch their account real detail, their banking accounts. They don't watch them like that. So since it's variable, it comes down. So just pay attention to that. The other thing that I'll share with you that I do that is savings, and you talked about passive income streams. All right. So many, one of the things I think I said to their brothers this week or last week was these ladies chatting about, they were really talking about the financial wealth gap, but I just sent a small thing, and they talked about how in our community, the African American community, most of our wealth, almost 80% of our resources and finances are in the real estate market, where I don't want to say the white community, but the other communities, 80% of their wealth is in the stock market. There's a couple of reasons. Again, neither of those is wrong, and both of them have the ability to be successful. But by and large, the stock market is the engine that drives the U.S. economy. All right. And so what I tried to do was to find a portion of the stock market that allows me to participate in both. So in the stock market, they have a stocks category that's called REITs, Real Estate Investment Trust, REIT. And what a REIT is a federally regulated category of real estate brokerage companies. and that they own positions or shares. There are REITs, by example, that own categories that include spaces that are leased to Walmart, Target, things like that. Then there are places that rent spaces to apartment complexes and residential things. I give you an example. At Prairie View, most of us are Prairie View affiliated. We have American Campus Communities, which was bought out by Blackstone. Blackstone is a REIT. So when our student population leases a house on campus right now, they pay their rent. That rent goes to American Campus Communities. American Campus Communities is a company that's owned in its entirety by Blackstone. Blackstone's a REIT traded on the New York Stock Exchange. I managed American Campus Communities for Prairie View for 20 years. I know that it has a 96% occupancy rate. There's almost impossible. There's a wait list every fall to get in there. My daughter attends there right now and pays to live. So I know that that's a solvent business model that they're using. So I bought stock in there. As I mentioned, I stay at Marriott, so I own Marriott. My wife drinks Coke, so I own Coke. My daughter is a college student staying in student housing that is managed by Blackstone, so I own shares in Blackstone. It's a REIT, which allows me to participate in the real estate market. By federal regulation, a REIT has to pay a dividend monthly, right? So every month you get a check from a REIT. So if you're trying to build what do you call it? Another revenue stream, right? Instead of saying, "Oh, I'm gonna buy this house and I'm gonna renovate it, I'm gonna fix it up, I'm gonna rent it out, and then I'm gonna collect revenue." When you spend $150,000 to buy the house, you spent $20,000 to get it, fixed up and function the way that you want it to. Then you had to go to a broker or somebody to get a tenant in there. Then that tenant is going to pay you. Let's say you're making good money, you're going to get $2,000-3,000 a month. It's going to take you how many months to get back the $150,000 base investment that you started with? For me, I say if I got $150,000, I'll put it in a REIT. It's going to start paying me a dividend immediately. I have no expenses associated with that asset at all. So if the market dips a little bit and the value of that REIT stock goes down a little bit, guess what doesn't go down? My monthly dividend. It's the same. The dividend's not based on the value of the stock. The dividend is based on the number of shares in which you own. So when that REIT goes down, you guys have been seeing a note from me that say, it's a red apple sale, right? So when that share price goes down, we think, I'm losing money, I got to get out, blah, blah, blah. Well, not the investor. The investor says, hey, I get a dollar a share. They give me $1 a month dividend. So instead of paying $3 a share for this, it's on sale for $2 a share. I can get more of them, and I'm gonna get more dividend at the end of the month. That's how the game is played by people who are managing and we are taught to worry really financially about most of the things that are not relevant to being successful in the stock market. In the stock market, you never lose money unless you sell. If I bought a stock at $50 and that stock doesn't go bankrupt and it's valued only at $1, right? Your mind tells you, I lost $49. No, I'm down $49, but I still own that one share. I'm down $49, and if that's a dividend stock, because I own that one share, I'm going to get the same dividend whether the stock is valued at $49, $50, or $1. That doesn't change. So dividends Steve, dividends is another way to generate passive income. That's just another passive income stream, right? That you're using you can use the stock market to do. So my portfolio is, I've been doing it for a while, so it's pretty broad. But dividend investing and passive income stream is one category of my portfolio, and it happens to be the category of my portfolio that I'm focused on right now. As I'm approaching the time to retire, I wanna get my dividend, my passive income stream up to where, hey, if I stop working, I don't have the same amount of money that I'm doing now. I have more. I want to have more money because 5 years from now, the cost of living goes up, right? So you want to set yourself up so that you have the resources in which to survive no matter what happens in our economy. If that makes sense.
Yeah, it does. And I know you're going to send Blake some info, but I'm definitely, if you have some suggestions for the REITs.
Oh yeah, I can tell you one or two right off. So REITs, there's a lot of them. All right. And so you really, as I would say, focus on the sector of REITs that you're interested in. Right. So like I said, you have commercial real estate, you have residential real estate, you have all of these categories. One of the there's two REITs. I'm in another group, and there's one of my a friend of mine. I'm helping her build out hers. All right, and she's a beginner, entry level. There's two REITs that I recommend. The first is one of the most popular, strongest REITs is ticker symbol O. All right, O is a REIT. It trades for about, it goes up and down. REITs really don't move that much on value. They're fairly flat. So it trades for about between $49 and $51 a share. All right. That's ticker symbol O. It's a more established one. It pays a good dividend. It pays about O pays about 26 cents a share. All right. Every month.
You put your chicken in here to drain.
Earl, tell Trina to hold on now. But
yeah. Hey, but real quick, I wanted to say to the brothers real quick, some stuff that you said. Number one, particularly to brother Stephen. I know you were talking about how you and your wife were trying to talk about how to save money and whatnot. And traditionally black folks, we don't necessarily save, like we should. But the other thing is also we are afraid of what we don't know, right? And because we don't know and never have been taught this financial system that we belong to, right? This system was not designed for us to win in, right? We were never taught it in school. Your parents didn't, your parents were never taught it, et cetera, et cetera. So you don't know how to work if you don't know the rules of the game. So I would encourage your brothers to go do a little bit of research on what our financial system actually is and how it operates, so that you know and understand what you need to do with your money in order to basically be on the same level as these white folks, and others who are at the top of that game. So one of the things I would encourage you, Stephen, to do for sure is to make sure that you and your wife are diversifying your portfolio, right? Because when I heard you speaking, it sounded like a lot of things that you were putting your money in were basically safe things. Things that didn't really generate a lot of money, but it was making sure that you didn't lose your money. So I would encourage you.
That's my wife's design. She's very risk averse.
Right.
Yeah. Right? So I cater to that a little bit, but I know, little risk, little reward.
My wife says about once every 3 or 4 weeks. Well, let's sell it all and put it in something where we're not going to lose money. But that is, a philosophy that some people have. But to Earl's point, she was taught how to manage money a certain way, and it was a very safe way, and that's what she does. If you to extend on what he says, there's a couple of things that I learned along the way. One, the early principles of money management and finance that I learned from my parents. My father didn't have a high school diploma, and my mother's international. So the things that they learned were survival things, right? They're managing money in a way based on trial and error, on just wanting to live and survive. And so that is the philosophy that many people across our community, that's the way that we function. But that doesn't mean that that's the only opportunities that there are around us. I've done fairly well as a professional, and I would be in my neighborhood, and I would look across and I'd say, man, how the heck does my neighbor have 4 ATVs out there, a boat, all of this stuff? He get up and go to work and come back home the same times as I do. What is it that's different? What's he doing differently than I'm doing? Well, in his family years ago, they learned some of these principles. What if you got to a point where you were generating $1,000, $2,000 a month in addition to your basic revenue that you earn through working? What if you had an extra $2,000 a month coming in that you didn't have to do anything for? And since you didn't have to do anything for, guess what? What if you didn't need it? And then that $2,000, if you left it in there, the month after that, it became $2,050. If you left it in there, the month after that, it became $2,060, $2,070, and it kept going. And then you didn't have to do anything with it for 10 years. What amount of money is it going to be? Those are the things that we just haven't been taught. Now, I'm gonna take the racial factor out of it, okay? And let's just talk about if you create a business, you create a business. The business is designed to make you money, right? That's the purpose of business. So when the businesses that we participate in, whether they're federal, state, local, whatever, when we participate in those businesses, the businesses are marketed as such that they're supposed to be best or benefit us, but they're designed to make somebody money. That's what they're designed to do. And so however it can convince you that it's the best thing for you, that's what you're going to get. I'm going to give you all an example, and some of you may personally be victims of this. When you go and buy a car, all right, they ask you, well, when do you want your payment? Do you want your payment on the 1st? Do you want it on the 15th? Do you want it on the 20th? Why does it matter? In your mind, it's why does it matter? I want to pay a certain amount. That should be the issue. The issue should always be, how much am I paying for this car? But they make it about the payment, right? The amount of the payment that you have to make and when the payment is due. Why is the payment due date so important? Well, because banks function on a premise of what's called a lockbox. If you go to a bank right now, there aren't bankers in banks anymore. They're customer service representatives. They only know how to talk to you about whatever the script is. If there's anything that's more complex or more detailed, they're going to have to call somebody who's going to have to get you in contact with somebody who is really a banker skilled in that area. Well, to the lockbox, what happens is if you say, oh man, I get paid on the 1st and the 15th, set my payment up on the 17th. Well, the lockbox has two, maybe 3 dates that they clear. The lockbox. So you pick the 17th, so they're going to put you in a lockbox that clears on the 14th. You make your payment on the 17th every month religiously. Well, guess what? The front end system that you're looking at, your account online or whatever, shows payment received, account updated, but your true balance hasn't changed. So you pay interest on a higher number from the 17th all the way to the 14th. You're paying because your money's sitting in a lockbox. You're current, you've made your payment, but your principal balance is still higher. You extrapolate that over 5 to 7 years, you may pay another 7 to 8%. If you do that same thing on a house, you're going to pay that over 30 years. It's going to cost you several $100,000, not a couple $1,000s. That's what the financial system is designed to do, to make the bank money, right? So what do you need to do? You can't fight the system necessarily. You can't change it. What you can do is you can look, and your thing tells you, every statement says this is based on 30 days or 31 days, blah, blah, blah. It tells you right on the statement. You can look at it and you can work your way to figure out, when is my payment clearing a lockbox, right? All you got to do is move your payment to the front of the lockbox. Most people get paid a week or 2 weeks before the payment is due. Some people may pay it early. Some people may pay it right when it's due. But generally speaking, a lockbox is a week and a half to 2 weeks prior to the due date, generally. So if you make your payment a week and a half to 2 weeks prior to the due date, what you're going to start to see is your principal balance is going to come down a lot faster. You're not paying more, you're just paying less interest. And your balance is going to come down, you're going to pay it off faster. That's a financial system understanding that most people aren't going to get. The bank's not going to teach you that. I luckily fell into that because years ago, my dad bought me a Ford, and Ford Motor Credit was dealing with that. And I bumped into a person who worked at Ford Motor Credit, and they accidentally told me something, and I was accidentally listening and trying to figure out what they were doing. And I backed into this. And then since then, I've known 50 bankers, and I've talked to them, and they're like, oh, how you learn about that? They want to know. How do you know? But that's a system that's running in the background of every financial credit transaction that you have right now. It's a lockbox. All right. So the understanding that the system isn't designed to help you. And in some of my other conversations, some of my other talks, I always say, remember, there's a cost for convenience. Anytime they make something easier for you, it's costing you money. No matter what we're talking about, it's costing you money. A milk truck can leave the milk manufacturing place and stop at 7-Eleven, H-E-B, and Walmart. Same truck drops off milk at all of those places. Is the price of the milk that you're buying in the same jug, is it the same at each location? No, it's not. The most expensive place is what? The convenience store, the gas station. They charge you the most. Why? Because it's easier to get to. You don't have to go to the store and walk through the line and walk to the back of the store, blah, blah. You get in your car, you get out, you pump your gas, you walk in, oh, they got milk, I grab it. It's easy. But they're charging you $6.99 for a jug of milk that at Walmart you can get for $1.99. Same jug. All right? There's always a cost for convenience. Always. Other stuff, Stephen, did I get all your questions? Did I answer all of your questions? Earl jumped in on me.
Yeah. I mean, I'm consider myself financially savvy, but there's a lot I still need to learn. So I'm just kind of listening and picking up tidbits, and I look forward to our next session. Maybe a suggestion, because I know we're kind of jumping all over this place, right? Maybe we hone in on a particular topic each session, or however you want to do it. I mean,
no, that's good. So for this one, we really only had one question. That was from Blake, and that was, how do you get started on the stock market? That's why I started with him and saying, hey, I'm going to send you this information offline separately so that you can get that. That's why we did that. As brothers have specific topics and things that they want to talk about, absolutely, we can do that. We can do that because finances is very broad. There are so many different things that we can talk about in these conversations. Other people are going to, Earl said 2 or 3 things that I didn't think about talking about that are very valid and very relevant. He's married. I'm married. You mentioned you're married. When you have a household, your dynamics are such. Each wife has their own views. In some families, the wives are more aggressive, and in some families, the wives are more shop affiliated. They're not save affiliated. So it's different in every house. So
No, yeah, I mean, you're right. I mean, we went over dividends and stocks and
it's a lot.
bonds and
It's a
it's a
lot.
lot. So
It's a lot.
I'd like to kind of brush up on every topic, right? Because they're all ways to build wealth.
Absolutely. Yeah. So on a group thing, as brothers send topics in, I have about 3 of these that I do, and so as I'm talking, sometimes the other conversation is playing in my head as well. So, but as brothers send in topics that we can talk about, we'll find that other brothers. I know one of Earl's brothers is a big time stock guy. I mean, he's way out there on some other level stuff. You talked about day trading and crypto. We have people who are in that game. I'm not in that game just because my confidence level of the system isn't there. Not that I don't trust the tool. I don't trust the managers of the tool, and there's no system of regulation and control. So I'm not there yet. But I'll tell you one person that I don't fancy financially is our the Tesla guy, Elon Musk. But guess what? I own stock in SpaceX. His views, opinions, and me liking him don't have anything to do with the financial possibilities associated with the stock, the research, and where the data shows me this might be something that I need to be a part of, right? So I say that just to say, hey, separate these things out, guys. Hey, before we keep talking, Google's going to cut us off. We got 3 minutes left, brothers. 3 minutes left, and Google's going to cut us off. It only gives us an hour. Steve, you haven't said anything. You got anything you want to say?
Nah, I just jumped on I came on late because I saw the messages in the chat late. I don't be paying attention to the chat all the time, so I was like, let me see what they talking about on here. But yeah, I need to get more involved in it myself. Actually, I had started looking a little bit on my own, but I was kind of a little fearful about jumping out there on the stock tips and stuff like that. But I recently got started doing a little something on Robinhood.
Okay.
Stuff like that.
Yeah, Robinhood is one of the platforms that I use. Robinhood's a good learning platform. It's a good platform to learn. It's one of the ones I'll probably send Blake. It's a good easy one to learn on.
Yeah, I would also encourage the brothers to go on YouTube and look up investors for beginners or investing for beginners. ETFs, electronically traded funds, mutual funds, right? And what are the differences, right? Bonds, what is that, and how are stocks and bonds different, and how are they affected by the market, right? Because stocks and bonds are really on opposite ends of the financial spectrum when it comes to when the market is up or down. They are inversely affected, when the market is up or down.
Yeah.
So it's learning those little things in terms of our financial system that will make you feel a little more comfortable with putting your money into that system. Because once you understand how the system operates, then you kind of feel more comfortable with okay, I'm gonna put my money here because I know how it works. And if it does this, I'm gonna do that. If it does this, I'm gonna do that. So you start getting more comfortable with putting your money in these different vehicles. In order for you to make money, because the idea here.
Earl, let me cut you off. It's gonna cut us off in just a second, brothers. I will send the chapter on a group thing. I'll send some other dates after Thanksgiving. We can have our second talk. If you have an idea or something you want to talk about, send it in. All right.